Good morning, everyone. Welcome to Monday Minutes. Welcome to 2024. First and foremost, Happy New Year. The year, in my opinion, of having an open mindset, maintaining an open mindset, certainly boundaries, and the road to neutral, which is going to be bumpy. Starting off on Friday, we had some large positions in the marketplace, in and around 4% heading into the payroll number. If you look at this number, kind of mixed picture, right? If you look at the establishment survey, certainly creating jobs, but many of those jobs are coming from the government, not the private sector. And then if you look at the household component, we had a big drop in a big increase in unemployment, and at the same time we had a big number of people leave the labor force. So labor force participation coming down, which was met at 10 o'clock on Friday with the ISM services number with a very, very big drop in employment. Now, a diffusion index measuring the month-over-month change, so not absolute activity. And if you go back historically, even to last year in 2022, if you look at that November to December period, typically a drop, which we saw last year, and a rebound. But this drop on the employment side was very, very large. I think a lot of market participants took note of this, and certainly the labor market in and of itself, we think will be critical here going forward with regard to rate cuts, the timing of potential rate cuts, and potentially the magnitude. But the employment market for sure, if you look at the ISM survey numbers, still rebalancing. We're seeing a lot of talk of people looking for hybrid scenarios. The work from home posture that's been out there coming out of the pandemic, certainly a variable playing into the labor market as we normalize and rebalance here in 2024. The Powell pivot. In general, look, the chairman, in our view, has skewed the rate structure in the right direction. If you look at historical periods of time where the Fed begins to talk about rate cuts relative to a central bank that's on hold, typically what you see is what we have seen, which is a duration grab with a slight steepening of the curve. But if you look at the 2s-10s curve, obviously was still inverted. So we had this massive duration grab, probably a little bit too much. Financial conditions loosening dramatically. If you look at the tightening that we saw over the summer into this year-end period of November and December, certainly financial conditions, we erased all of the tightening that we had. We erased that tightening within a very, very short period of time. So a little give back here makes sense. But in general, our view is that the chairman has skewed the overall rate structure in the right direction with doing really nothing here, but just talk about this notion of rate cuts. That leads us into the conversation that we had over the weekend. If you look at the FOMC minutes, certainly the Fed is talking about the balance sheet. We expected to get a little bit more clarification from Dallas Fed President Lori Logan, who certainly will be the point person for the Fed in terms of the balance sheet and those dynamics. And her speech was actually quite interesting. She's always very insightful and thoughtful. If you look at what's going on with the balance sheet here, if you look at the reverse repo facility, which has come down dramatically, more than offsetting quantitative tightening, and at the same time coming out of the debt ceiling issues over the summer, replenishing the Treasury's general account. So as she pointed out in her speech, overall bank reserve levels have actually gone up, which is pretty amazing given the drain that we've seen out of the RRP. But the concern here is as that reverse repo facility continues to move lower here, at some point, the Fed is going to discontinue balance sheet runoff. We expect to get more clarification on that in the months ahead. But nonetheless, the Fed is clearly signaling to the market here that they want more than ample reserves in the system. They manage the reserve base as an aggregate, and it's not always proportionate in terms of who's got reserves that could be abundant and perhaps other institutions that need reserves. So that redistribution, how that process works, the speed in which that balance sheet comes off is relevant. And I think what the Fed is signaling to the market here is they will provide more guidance into 2024 here in terms of how that dynamic plays out. The other thing that Dallas Fed President Lori Logan spoke about was financial conditions in general. So as we talk about rate cuts, she's talking about the notion potentially of maybe having to do more in terms of rate hikes, right? Which is interesting, saying that we really erased most of the tightening in financial conditions over the summer into these last 2 months. The markets perhaps moved much quicker than maybe the Fed expected. But to her point, and she is correct, it was a combination of signaling, communication from the Fed, i.e. Chair Powell, and at the same time, data that cooperated this disinflationary force, inflation coming down much quicker than I think the Fed expected and perhaps many market participants expected. So the notion of rate hikes from here, look, the bar for rate hikes, for higher rates here is, in plain English, it's very high. I think the market knows that. So the chairman skewing rates lower here, the market pricing in rate cuts as the next move is certainly the logical step. But it always pays to take a little breath and a little bit of a pause. And I think that's what we're doing here. We're seeing a slight retightening of financial conditions. Markets moved a lot. It's healthy. We expected consolidation with rates. 10-year yields coming in and around 3.75. We've backed up. If you look at estimates of real GDP growth, if you look at estimates of where inflation is, if you look at market-based inflation expectations, certainly 10-year yields, nominal yields in and around 4% to us seems much more balanced. Rate cuts, we have about 5 priced in. Look, I think the reality is it's unlikely the market gets this right, in both directions. So we had 6 priced in. Now we have roughly 5 priced in. We're taking the froth off here a little bit. I would pay very close attention to the labor market moving forward. Inflation has come down. If you look at the 3-month and 6-month numbers, certainly coming down in and around very close to the Fed's target. But at the same time, we see the employment market right now, which on the surface presents like, yes, we are still creating jobs, but if you look under the hood, it's not quite as strong. So the evolution of these numbers, and between now and March, this meeting at the end of the month, February 1st, will certainly come and go, but between now and March, it's light years away in terms of data. We still think March is a little bit tight here for the Fed to lower rates, but I think certainly if the employment picture does continue to loosen up, the Fed is not going to be afraid to take some of the froth away at a minimal. If you look at the 75 basis point hikes that we had in 2022, outsized aggressive hikes, they could easily shave 25 basis points off of each of those hikes and take the Fed funds rate down closer to low 4s to 4%. And then lastly, this week on the ground, New York Fed President Williams will talk on the economic outlook, very close to Chair Powell, in a circle. The market's going to be paying close attention to what he has to say. We shift right back to inflation. It's going to be employment and inflation for the foreseeable future in terms of rate cuts and Fed policy. We have CPI and PPI, and then we also get U.S. Treasury issuance in the form of 3s, 10s, and 30s. It'll be a good test for the market on the long end of the curve, as right now at 4%, we're over 100 basis points lower than where we were not too long ago. So this will be a good test for the market. We also get bank earnings, and as we're seeing in the first couple of weeks of 2024, the chairman set the stage. Very, very conducive conditions, a much better setup in 2024 than 2023. We're always on the lookout for hiccups. We didn't know what was going to happen in March of 2023, but certainly the setup for this year seems very conducive, and we're seeing issuers come to the market. Wishing everyone a great year ahead. I'm Greg Faranello. I'm head of U.S. rates for AmeriVet Securities.